All right, so this part of this chapter, Learning Objective 3, basically introduces you to something called an accounting journal. The journal is the very, very first place that accounting actually starts in writing. But as you saw from the last couple of objectives, how much analysis has to get done before we can actually write this stuff down in the journal. Okay, so the journal basically is where things are recorded. Okay, so we analyze things and then we enter it in the journal. All right, so we're going to be focused on the journal and Learning Objective 3. The numbers travel from that journal to the general ledger, which we'll talk about next class. But today, all about the journal, all about the journal. So again, if you want to just focus on this particular thing, the one in the middle, we've already done the analysis. We've already sat down. Learning Objective 1, Learning Objective 2 was all about that analysis piece of what accounts were affected and do we have more in the account or less in the account. And then Learning Objective 2 said, okay, if we had more cash, what side would it be on? You said, well, it's the debit side. If we had less cash, what side would that be on? It'd be on the credit side of the cash account, right? So we did all that analysis. So the journal is simply writing it down. Okay, so the general journal is the focus today. We're simply going to write it down and start the accounting process. This is the focus today. This is what's going to happen next week, next class rather. Okay. Everything in the journal is recorded chronologically. In other words, when it's happening is when we're supposed to be marking it down. Okay. So when you look at a journal, not only would it be organized by date, so what's happening today will be listed, tomorrow will be listed, the next day will be listed, etc. But it should be basically by time as well. So if something happened at 1 o'clock, that would be recorded before something that happened, say, at 4 o'clock that afternoon. So it is chronological in that sense. So you'll see it by date, okay? And basically speaking, this is what you're going to be learning today. The actual putting in the entry in the journal is something we call journalizing. So it's basically entering the data in the journal. And we're going to go back to our lovely Sierra Corporation transactions. There's 3 of them that we're going to be looking at. So on the 1st of October, you might have remembered they issued common stock in exchange for cash. Okay. We analyzed this, right? And then you figured out that cash is affected on the debit side, common stock accounts affected on the credit side. You figured all that stuff out. In the journal is where we write it. Here on the second transaction, they borrowed money. We had more cash. We had more notes payable. We figured that out. More cash is on the debit side of the cash account. More accounts payable is on the credit side of the accounts payable account. So we figured all that out. That's all the analysis we did. And then the very next transaction, they bought equipment for cash. We thought about, okay, we have more cash. We have more equipment. And so that's a debit to equipment, but we have less cash. And so cash shrinks on the credit side, so a credit to cash. So we thought all about this. Now it's time to write it down. And that's really all we're doing with the journal. So again, all the analysis we went through, Learning Objective 1 and 2 is all about that analysis. Once you figured out that we have a debit to cash and a credit to common stock, that's what we write it in the journal. Okay. So the journal basically will have, most journals will only have about 4 columns. The reference column is in some journals, sometimes not. The first column is always the date because we record things chronologically, right, by date. The second thing we do is the second column we'll see is the column for the titles of the accounts. So cash is affected, common stock is affected. And the reason that they're listed this way is going to be explained on the other side of this journal. There are 2 columns for the numbers. Okay, 2 columns for the numbers. The first column is the debit column. The second column is the credit column. And if you look carefully, it makes a lot of sense, right? Because that's how That's how accounts are set up anyway. Accounts are set up with a left side or a debit side and a right side or credit side. So in that sense, it mimics what an account would look like. No problem, right? So notice that the debit column is the first column and the credit column is the second column. So that's why the accounts are listed the way they are. The first account is cash because cash is affected on the debit side. The debit column is the first column the numbers go in the journal. So we always will start with what account is debited first. We will end with what account is credited. So common stock is credited, and you'll see the 10,000 in the credit column. Notice too that common stock, the account that's credited is indented a little bit. Okay, it's indented a little bit in a journal. So that's what you'll see in a journal. And this is basically journaling. That's it. It's not that difficult a thing because we've done all the analysis. All the analysis had to get done first. The journalist is writing it down. Okay. Again, on October the 1st, later that day, we borrowed money. We analyzed it. We had more cash. We had more notes payable. We said, okay, cash increases on the debit side, notes payable increase on the credit side. We did all that analysis. This is what it looks like in the journal. The date is listed as October the 1st, which is when it happened. And again, the accounts are going to be listed. The account that gets debited is going first, will be listed first, because the debit column is listed first where the numbers go. The account that's credited gets listed second, because again, the credit column is the second column where the numbers go. So debit to cash would show up here, a credit to notes payable would show up here. That's what it would look like in the journal. Okay. You go to the our last transaction here for the journal. In this example, they purchased equipment for cash. We had more equipment. We had less cash. We analyzed it. Okay, more equipment would happen on the debit side, so a debit to the equipment account. Less cash would happen on the credit side, so a credit to cash. That's all the analysis. We simply write it down in the journal. This happened on October the 2nd. The account that gets debited is equipment, so equipment's listed first, $5,000 debit. Cash is listed second with a $5,000 credit. And this is what a journal looks like. You're gonna, I mean, if you print it, it's very long most of the time. Most companies are very busy. And basically, this is what you would see in a journal. And that's basically what you're going to be doing for homework. That's it. You're just going to be, all that analysis you did in the first two objectives is written down here in the journal. That's basically the deal. Okay. So your do it exercise as given to you in your book. This is about Kate Brown's beauty salon called Hair It Is. I must have went to her competitor. Hair It Went, because I'm getting less and less hair over time. And so again, very common because it's a corporation. This Inc. means it's incorporated. And this is how corporations start, right? Shares of stock for cash, always, 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 always. So you're going to see this all the time. And you've already analyzed it, right? You got more cash, you have more common stock, right? So you know that's what's going to happen. So what does the journal entry look like? The journal entry looks like a debit to cash and a credit to common stock. This is how the journal would be set up. Of course, instead of the number one, it would be a date normally, but they don't give us a date, they just give us number one. Okay, so that's how it would look in the journal. Here we purchased equipment on account. Remember, on account, we have to pay it in 30 days. We analyzed it. We certainly have more equipment, but since we have to pay for it in 30 days, we have more accounts payable, right? So when you think about it, more equipment is a debit to the equipment account, more accounts payable is a credit to the accounts payable account, and this is how it would look in the journal. And the last thing she did was interview 3 people. That's nice, right? When you interview people, you're not giving them cash, so it's pretty much a done deal. No entry is required. So all of that analysis that you've done over the last week basically comes to fruition by writing it in the journal. But literally, it's the journal that starts the accounting process in accounting. That's where everything starts. But look how much thinking, look how much you had to know just in order to start doing accounting, right? It's pretty amazing. So that's what I wanted to introduce to you today. Really just wanted to have a short session just to get you, kind of ready. If I gave this to you last week, I don't think you would have spent enough time processing how to analyze the accounts. And that to me, the analysis is the most important thing, because once you get that analysis down, writing it down in the journal is easy. I mean, it's a no-brainer. So that's why I wanted to split it up for you. And I thank you very much for joining me on a very short session. But if there's any questions, I'll take them now.